Hello, welcome everyone. Today we're going to talk about the Managerial Accounting course, chapter 1, which is the Introduction to Managerial Accounting. The needs of management. What is financial accounting? Financial accounting is concerned with the reporting financial information to external parties such as stockholders, creditors, and regulators. Okay. Meanwhile, managerial accounting is concerned with providing information to managers within an organization so they can formulate plans, control operation, and make decisions. Purpose of cost classification is number 1, assigning cost to the cost object. Number 2, accounting is for the cost in manufacturing companies. Number 3, preparing financial statement. Number 4, predicting cost behavior in response to changes in activities. Number 5 is making decisions. Learning objective number 1 is that we need to understand the cost classification used for assigning costs to the cost object, such as direct costs or indirect costs. Okay. What are the direct costs? Direct costs is costs that are easily and conveniently traced to a unit product or other cost objects. Example is direct material on direct labor. Indirect cost is cost that cannot easily be identified or conveniently traced to a unit of product or other cost objects. Example is manufacturing overhead. Indirect cost incurred to support a number of cost objects. This cost cannot be traced to any individual or cost object. Learning objective 2, identify and give example of each of the 3 basic manufacturing cost categories. Okay. What are those? Direct materials, direct labor, and manufacturing overhead. Okay. What are direct materials? Direct materials are raw materials that become integral part of the product and that can be conveniently traced directly to it. Example is radio installed in an automobile. Direct labor. Direct labor are those labor costs that can be easily traced to individual unit of a product. Example, wages paid to automotive assembly workers. Manufacturing overhead. Manufacturing overhead include all the manufacturing costs except direct materials and direct labor. These costs cannot be readily traced to finished products. Example include indirect materials that it can easily trace or conveniently trace to a specific unit of a product. It includes indirect labor, costs that cannot be easily or conveniently traced to a specific unit of product. Manufacturing overhead example are like depreciation of a manufacturing equipment or any utility costs, property taxes, or insurance premium incurred to operate a manufacturing facility. Only those indirect costs associated with operating factory are included in the manufacturing overhead. What are the prime and conversion costs? My costs are often classified as follows. Direct materials here, direct labor, manufacturing overhead. These two combined, both direct material and direct labor, called prime costs. Direct labor and manufacturing overhead is called conversion costs. Okay. Non-manufacturing costs. Selling costs. Selling costs are costs necessary to secure the order and delivery of the product. Selling costs can be either direct costs or indirect costs. Administrative costs are all executive organizational and critical costs. And the costs can be either direct or indirect costs. Okay. Number 3, learning objective 3. Understand cost classification used to prepare financial statements such as production costs and periodic costs. Okay. What are the product costs? It includes all the costs that are involved in acquiring or making a product. Product costs attached to a unit of a product as it is purchased or manufactured as they stay attached to each unit of product as long as the unit remains in inventory and waiting for the sale. Manufacturing costs or product costs include raw materials, work in process, and finished good costs. It has all each definition here. You can read through in my presentations. Okay. Transfer costs. Transfer costs of the product and direct material are used in production. Their costs are transferred from raw materials to work in the process. Direct labor and manufacturing overhead costs are added to the work in process to convert direct materials into finished goods. Once units of product are completed, their costs are transferred from work in a process and finished goods. Manufacturer sells its finished goods to customer. The costs are transferred from finished goods to the cost of goods sold. Okay. Example of cost classification here. Product costs include direct materials, direct labor, and manufacturing overhead. There's inventory here, goes into the balance sheet. Cost of goods sold, when there's a sales here, it goes to the income statement. But the costs include all selling costs and administrative costs. Okay. Expense go to the income statement. Concept check. Which of the following costs could be considered period rather than a product cost in manufacturing company? Either A, manufacturing equipment purchasing, B, property tax and corporate headquarters, C, direct material costs, D, direct costs to direct productions, facility, E, sales commissions. What are the things, okay, that can be considered period rather than product? So the answer will be B and E. Okay, that's the one. Okay. Next one, learning objective number 4, understanding cost classification. Use the periodic cost behavior such as variable costs, fixed costs, and mixed costs. Okay, cost behavior refers to how costs will react to changes in the level of activities. The cost of classification are variable costs, fixed costs, and mixed costs. Okay, let's decide the definition of each. Variable cost, a cost that varies in total in direct proportion to changes in the level of activities. Variable cost per unit is constant. Example, unit produced, miles driven, labor hours, machine hours. A measure that cost of production or variable cost. Okay, those are the components that involve the activity base of a cost of a driver. Okay. Now, let's see what is the fixed cost. A cost that remains constant in total regardless of changes in the level of activities. It expressed on per unit basis. The average fixed cost per unit varies inversely with changes in activities. Example, type of fixed cost. Committed. Long-term cannot be significantly reduced in short-term. Discretionary may be altered in the short-term and current managerial decisions here. Okay, this is the difference. Okay, look at the linearity, assumption of real relevant range here. Let's go all the way here. Straight line closely shows approximate to culinary. Variable cost line within the relevant range. Okay, accountant straight line approximate constant of the unit variable cost. This is the economist curvilinear cost functions, the green one. This is the relevant range. You see the chart here. Okay, fixed cost and relevant range. Okay, the relevant range of an activity pertains to fixed costs as well as variable costs. Example is office space at a rental at a rate of 30,000 per year, increment 1,000 per square feet. So the fixed cost would be in staff fashion a rate of 30,000. The relevant range, will we look in the next chapter here. 1,000 is 30,000 here. You got a relevant range will be between 1,000 to 2,000. This is relevant range of activity for fixed costs, or with which the graph of the cost is flat. Okay. Now, comparison of cost behavior and predicted cost behavior. You see within the variable and fixed costs in total and compared to the per unit. In total variable cost increase and decrease in proportion to the changes in the activity level. In the fixed cost, the total fixed cost is not affected by the changes in the activity level within the relevant range. Per unit, variable cost per unit remains variable constant. Fixed cost per unit decreases as the activity level rises, increases as the activity level falls. Okay, those are the behavior within the variable versus fixed cost. Concept chapter number 2. Which of the following costs would be viable with respect to the number of ice cream cones sold in Baskin Robbins? There may be one or more correct answer. Okay, either A, the cost of lighting store, the wages of the store manager, the cost of an ice cream, and the cost of napkins to the customer. Okay, remember, variable cost with respect to the number of ice cream. So it will be the cost of ice cream and the cost of napkins for the managers. Okay, those are the related variable costs, okay, to the ice cream. Mixed cost. Mixed cost, part 1, contains both variable and fixed element. Because the example is utility cost. If you have a utility cost, that's an issue. You got a total mixed cost here. You got a fixed cost here, variable cost here, and you got the fixed cost monthly here. This is your fixed cost. This is your variable cost here. Look, this one, variable cost here. This total mixed cost here. Okay, this is your fixed monthly utility change here. Okay, you got, let's say, 1,000 rental. It's all 1,000. Variable depends on the production. Total mix will be your curve line. Okay. Now, what the equations? The equation will be A equal to A plus BX. Y include the total mixed cost. A is the total fixed cost, which is a vertical intercept of the line. Number B is the variable cost per unit activities, and the X is the level of activities. Example here given to you. In the real life example, fixed monthly utility charge is 40 bucks. Your variable cost is 0.03 per kilowatt per hour. Your monthly activity is 2,000. What is the amount of utility bill? So you're gonna put this logic. Y equal to A plus B X. Y is equal to 40. Where is the 40 coming from? It's 40A. B is 0.3 times 2,000. You got Y equal to 100. That's the learning objective number 4. Look at the objective number 5. Understand cost classification used in making decision, relevant costing, and irrelevant costing. Decision involves choosing between alternative. The goal of making decision is identify those costs that are relevant and irrelevant to the decision. To make decision, it is essential to have a grasp of concept of decision costs and revenue, opportunity costs, and sunk costs. Okay. Different costs are difference in cost between any two alternatives. A. The difference is revenue between two alternatives is called differential revenue. Both are always relevant to decisions. Different costs can be either fixed or variable. Opportunity cost. The potential benefit that is given up when one alternative is selected over another. Okay. These costs are not usually found in accounting records but must be explicitly considered in every decision. For student, what is the opportunity cost for you to incur by attending class? Okay. Some costs have already been incurred, cannot be changed now or in the future. These errant costs should be ignored in making decisions. Okay. Concept check will be, suppose you are trying to decide whether to drive to take a train to Portland to attend a concert. You have a cash to either one of them, but you don't want to waste money needlessly. Is the cost of the train ticket relevant to this decision? In other words, so the cost of train ticket affect decision whether you drive or to take a train. A. Yes, the cost of train ticket is relevant. No, the cost of train ticket is not relevant. The answer will be yes, because the cost of train ticket is relevant. Okay, concept number 4. Suppose you are trying to decide whether you take a drive or to take a train to Portland to attend concert. You have an ample of cash to either, but you don't want to waste money. Needless to say, is the annual cost of licensing your car relevant on these decisions? Of course, the licensing of the car is not relevant. Okay. Concept number 5, we're gonna check. Suppose that your car should be sold now for 5,000. Is this a sunk cost? The answer will be no, it is not the sunk cost. Okay. Learning objective number 6, which is to prepare income statement for merchandising company using traditional and contribution format. So this is the way, the traditional format on the left side, which is less, but contribution format, which is much longer. This is used primarily for management, okay? And this is used, the traditional one is primarily used for external reporting. I am a CMA. When I was a CMA, I do mostly the contribution format. Mine is Certified Management Accountant, so we are mostly doing a lot of costing, okay? Look at the use of contribution format. The continuous income statement format is used for internal planning and decision-making tool. We use this chapter, including for number 1, cost volume profit analysis in chapter 6. Then we're going to discuss later. Number 2, segmental reporting for profit data, chapter 7. Number 3 is budgeting, chapter 8. And number 4, special decision making for pricing in chapter 11. So this is basically the end of the chapter. Okay. So I want to make sure that this is the book that we use. Okay. We are using a book that is based on a 9th edition Managerial Accounting, done introduction available from McGraw-Hill. So this concludes chapter 1. So hopefully you enjoy the class. I'll see you in the next chapter. Bye-bye.